Have you ever wondered why financial markets behave so radically, shifting sentiments in an instant? Despite the apparent chaos, research reveals a hidden organization and an organic fractal nature beneath the surface. This video aims to clear the fog that clouds traders' judgment, whether you're a beginner or an expert. Many traders suffer from physiological, analytical, and organizational deficiencies, leading to costly mistakes and lost capital. By sharing valuable lessons learned from experience, we hope to minimize your learning curve and help you avoid common pitfalls. Let's embark on a journey to decode the patterns and principles that govern market movements, starting with the fundamentals. One of the most powerful concepts in technical analysis is divergence. Divergence occurs when the price of a security moves in the opposite direction of an indicator, such as an oscillator. This can signal potential trend reversals or confirmations. Understanding divergence helps traders anticipate market shifts before they happen. There are two main types: regular divergence and hidden divergence. Each type provides unique insights into market behavior, allowing traders to make more informed decisions. Let's break down these types and see how they can be applied in real trading scenarios. Regular divergence is a classic signal for trend reversals. In a bearish regular divergence, the price forms higher highs while the oscillator forms lower highs. This suggests that upward momentum is weakening and a downward reversal may be imminent. Conversely, in a bullish regular divergence, the price forms lower lows while the oscillator forms higher lows, indicating that downward momentum is fatting and an upward reversal could occur. Recognizing these patterns early can help traders position themselves ahead of major market moves. Hidden divergence is often used to confirm the continuation of a trend. In a hidden bearish divergence, the price forms lower highs while the oscillator forms higher highs, confirming a downtrend. In a hidden bullish divergence, the price forms higher lows while the oscillator forms lower lows, confirming an uptrend. These signals are subtle but powerful, helping traders stay aligned with the prevailing trend and avoid premature exits. The moving average convergence divergence, MACD, is a widely used trend-following momentum indicator. It shows the relationship between two exponential moving averages, EMAs, of a security's price. The MACD line is calculated by subtracting the 26-period EMA from the 12-period EMA. A 9-day EMA of the MACD line, called the signal line, is plotted on top of the MACD line and acts as a trigger for buy or sell signals. Understanding MACD is essential for identifying market momentum and timing trades effectively. To calculate the MACD line, subtract the 26-period EMA from the 12-period EMA. The result is the MACD line, which reflects the difference in momentum between short-term and long-term price movements. The signal line, a 9-day EMA of the MACD line, is then plotted on top. When the MACD line crosses above the signal line, it's a potential buy signal. When it crosses below, it's a potential sell signal. These crossovers are among the most common ways traders interpret MACD. MACD indicators can be interpreted in several ways. The most common methods are crossovers, divergences, and rapid rises or falls. Crossovers occur when the MACD line crosses the signal line, indicating a change in momentum. Divergences between MACD and price can signal potential reversals. Rapid rises or falls in the MACD line indicate strong momentum, which can precede sharp price movements. Mastering these interpretations helps traders anticipate market action and make timely decisions. The Elliott wave principle is a foundational concept in technical analysis. It describes how market prices move in repetitive cycles, driven by investor psychology. Waves are divided into impulsive and corrective patterns. Impulsive waves move in the direction of the trend, while corrective waves move against it. Understanding Elliott waves helps traders recognize the structure of market movements and anticipate future price action. Let's explore the basic rules and structure of Elliott waves. MACD can be used to identify key points in Elliott wave cycles. For example, MACD positive divergence often marks the start of wave 1, while a signal line crossing the zero line signals the start of wave 3. Positive hidden divergence indicates wave 4 is over and wave 5 is starting. Negative divergence signals the end of wave 5. These relationships help traders align their analysis with wave patterns and improve timing. Elliott waves are structured in a specific sequence. Impulsive waves always divide into 5 waves, 1, 2, 3, 4, and 5. These are followed by a corrective wave, typically labeled A, B, and C. The numbered waves move in the direction of the trend, while the lettered waves move against it. The structure is often described as 5-3-5-3-5, followed by 5-3-5. Understanding this structure is key to identifying wave patterns and predicting market moves. There are specific rules governing Elliott waves. Wave 1 can be an impulsive 5-wave or a leading diagonal. Wave 3 is always impulsive and never the shortest. Waves 5 and C are always 5 waves but may be ending diagonals. Waves 2, 4, and B always subdivide into 3-wave corrections. Wave 2 never moves beyond the origin of wave 1, and wave 3 must go beyond wave 1. Wave 4 never moves into wave 1's range. These rules ensure consistency in wave analysis. Guidelines help refine Elliott wave analysis. Waves 2 and 4 often alternate between zigzags, flats, or combos. Wave 4 can be flats, triangles, or combinations, while wave 2 is usually a zigzag or zigzag combination. Wave 4 usually terminates in the same area as the previous wave 4 of wave 3. Typical Fibonacci retracements for wave 2 are 50% or 61.8% of wave 1, and for wave 4, 38.2% or 61.8% of wave 3. Channeling laws often apply, with wave 5 ending around the channel line extension of endpoints 1-3. Impulse waves can be extended, meaning one of the waves, 1, 3, or 5, subdivides further and becomes elongated. Usually only one of these waves is extended, but in larger cycles both waves 3 and 5 may be extended. If wave 3 is extended, waves 1 and 5 are usually proportionally similar. If wave 1 is extended, wave 5 often terminates around the Fibonacci 61.8% of wave 1. If wave 5 is extended, it usually terminates around the Fibonacci 161.8% of wave 3. Extensions exaggerate the wave structure and are important for identifying strong trends. A leading diagonal is a special wave structure that occurs in wave 1 of an impulse or wave A of a zigzag. Diagonals always have 5 waves, with a structure of either 3-3-3-3-3 or 5-3-3-3-3. Waves 2 and 4 always subdivide into zigzag corrections. Wave 2 never moves beyond the origin of wave 1, and wave 3 must go beyond wave 1. Wave 4 must move into wave 1's range but not beyond wave 2. Wave 5 must go beyond wave 3 with no truncation. Diagonals can be contracting or expanding depending on the relative lengths of the waves. Guidelines for diagonals include the subdivision of waves 1, 3, and 5, usually into zigzags but sometimes into impulses. If wave 1 is a leading diagonal, wave 3 is usually extended, connecting the ends of waves 1, 3, and 2 forms contracting or expanding wedges. In a contracting diagonal, wave 5 usually ends beyond the wedge line of wave 1, 3, known as a throw over. In an expanding diagonal, wave 5 stops just short of reaching the wedge line. Fibonacci counts can help identify possible wave terminations. Ending diagonals are 5-wave structures that occur in wave 5 of an impulse or wave C of a zigzag or flat correction. The structure is always 3-3-3-3-3, with each wave subdividing into zigzag corrections. Wave 2 never moves beyond the origin of wave 1, and wave 3 must go beyond wave 1. Wave 4 must move into wave 1's range but not beyond wave 2. Wave 5 stops before reaching the end of wave 3, resulting in a truncation. Ending diagonals can be contracting or expanding, with specific guidelines for wave lengths. Expanding diagonals are 5-wave structures where each wave is longer than the previous one. They occur in wave 5 of an impulse or wave C of a zigzag or flat correction. The structure is always 3-3-3-3-3. Wave 2 never moves beyond the origin of wave 1, and wave 3 must go beyond wave 1. Wave 4 must move into wave 1's range but not beyond wave 2. In an expanding ending diagonal, wave 5 must go beyond the end of wave 3, with no truncation. These patterns are less common, but important for identifying strong trend extensions. A zigzag is a corrective pattern consisting of 3 waves, A, B, and C. The structure is 5-3-5, with wave B never moving beyond the start of wave A. Wave B is subdivided into a 3-wave pattern, which can be a zigzag, flat, triangle, or combination. Wave A can be impulsive or a leading diagonal, while wave C can subdivide into 5 waves as a diagonal or impulse. Zigzags are common in corrections and help traders identify retracement opportunities. Guidelines for zigzags include the parallel connection of waves A and C to the line, connecting the origin of the zigzag to point B. Waves A and C are usually equal in length and often subdivided into impulse waves. Wave C always ends beyond wave A, while A and C are often equal. Ratios in corrections are less accurate than in impulse waves. Typical Fibonacci retracements can be observed in charts, helping traders estimate the extent of corrections. A regular flat is a 3-wave corrective structure. Wave A is a 3-wave pattern and never a triangle. Wave B is subdivided into a 3-wave pattern and retraces at least 90% of wave A. Wave C always subdivides into 5 waves, either as a diagonal or impulse. Waves A and C are usually equal in length, and wave C ends around the end of wave A. Flats are common in sideways markets and help traders identify consolidation phases. A running flat is a variation of the regular flat. The structure is 3-3-5, with wave A as a 3-wave pattern and never a triangle. Wave B is subdivided into a 3-wave pattern and retraces at least 105% of wave A, often up to 138.2%. Wave C does not go beyond wave A and is truncated. Wave C always subdivides into 5 waves, either as a diagonal or impulse. Running flats indicate strong momentum and are useful for identifying continuation patterns. An expanded flat is another variation of the flat pattern. The structure is 3-3-5, with wave A as a 3-wave pattern and never a triangle. Wave B is subdivided into a 3-wave pattern and retraces at least 105% of wave A, typically up to 138.2%. Wave C always goes beyond wave A and subdivides into 5 waves, either as a diagonal or impulse. Waves C usually extend between 100% and 161.8% of wave A and C are not equal in length. Expanded flats signal strong corrections and are important for identifying reversal points. Barrier triangle is a 5-wave corrective structure, labeled A, B, C, D, and E wave A never goes beyond the origin. The structure is 3-3-3-3-3, with at least 4 waves subdividing into zigzags or combinations. In a barrier triangle, wave C never goes beyond wave A, and wave E never moves beyond C. Wave D ends around wave B, forming a straight flat line or barrier. Barrier triangles are less common but can signal sharp moves following their completion. A contracting triangle is a 5-wave corrective structure, labeled A, B, C, D, and E wave A never goes beyond the origin. The structure is 3-3-3-3-3, with at least 4 waves subdividing into zigzags or combinations. In a contracting triangle, wave C never goes beyond wave A, wave D never moves beyond wave B, and wave E never moves beyond C. Wave E ends around the AC line, typically undershooting or overshooting. Contracting triangles are the most common type and signal consolidation before a breakout. An expanding triangle is a 5-wave corrective structure, labeled A, B, C, D, and E wave A never goes beyond the origin. The structure is 3-3-3-3-3, with at least 4 waves subdividing into zigzags or combinations. In an expanding triangle, wave C goes beyond wave A, wave D moves beyond wave B, and wave E moves beyond C. Wave E ends around the AC line, typically undershooting or overshooting. B, C, and D always go beyond 100% of the preceding subwave but never exceed 150%. Expanding triangles are the least common and signal increased volatility. A double zigzag is a corrective pattern made of 2 zigzags joined by a corrective structure in the opposite direction, labeled X. The first pattern is labeled W, followed by X, and then Y for the ending pattern. Double zigzags take the place of a zigzag in a corrective move. Combinations happen more when the corrective flat or zigzag is relatively minor compared to the preceding wave, resulting in more consolidation and sideways action. Triple zigzag is a corrective pattern made of 3 zigzags joined by 2 corrective structures in the opposite direction, labeled X. The first pattern is labeled W, followed by X, then Y, another X, and finally Z. Triple zigzags take the place of a zigzag in a corrective move. Triple 3-flat combinations are rare and formed by a combination of 3 flats. These patterns signal extended periods of consolidation and sideways movement. Alternation is a key guideline in Elliott wave analysis. Waves 2 and 4 almost always alternate in form, with one being a zigzag and the other a flat or combo. This alternation helps maintain balance in wave structures and prevents repetitive patterns. Recognizing alternation can help traders anticipate the type of correction and adjust their strategies accordingly. Channeling laws are often observed in Elliott wave patterns. Wave 5 ends around the channel line extension of endpoints 1-3, and wave 4 may end at the parallel line point 1-3. Drawing channel lines helps visualize wave targets and identify potential reversal points. Channeling is especially useful in strong trends, providing traders with clear reference points for wave termination. Fibonacci retracements are commonly used to estimate wave corrections. Typical retracements for wave 2 are 50% or 61.8% of wave 1, while wave 4 retraces 38.2% or 61.8% of wave 3. These ratios help traders set targets for corrections and identify potential reversal zones. Applying Fibonacci analysis to Elliott waves enhances accuracy and provides objective reference points. Truncation occurs when wave 5 does not go beyond wave 3. This is called a truncated fifth. Truncations are rare but important, as they signal exhaustion in the trend and often precede reversals. Recognizing truncation helps traders avoid chasing moves and prepare for potential corrections. Waves can subdivide into smaller patterns, creating fractal structures. For example, wave 1 can divide into an impulsive 5-wave or a leading diagonal. Wave 3 is always impulsive and never the shortest. Waves 5 and C are always 5 waves but may be ending diagonals. These subdivisions allow Elliott waves to be applied across all time frames from minutes to months. Elliott wave patterns can be observed in all time frames from thick charts to 1 minute, 2 minute, 5 minute, 10 minute, 15 minute, 30 minute, hourly, daily, weekly, and monthly charts. The same rules and guidelines apply regardless of the time frame, making Elliott wave analysis a versatile tool for traders of all styles. Corrective patterns include zigzags, flats, triangles, and combinations. Each pattern has specific rules and guidelines for structure and subdivision. Recognizing corrective patterns helps traders identify consolidation phases and prepare for trend resumption. Mastery of corrective patterns is essential for accurate wave analysis. Impulsive waves move in the direction of the trend, while corrective waves move against it. Impulse waves are numbered 1-5, and corrective waves are lettered A, B, and C. Understanding the difference between impulse and correction is crucial for identifying trend direction and timing entries and exits. Proper labeling of waves is essential for accurate analysis. Impulsive waves are numbered and corrective waves are lettered. Double and triple zigzags use WXY and WXYXZ labeling. Consistent labeling helps maintain clarity and ensures that wave counts are reliable across different charts and time frames. Wave combinations occur when corrective patterns are joined together. Double and triple zigzags, double threes, and triple threes are examples of combinations. These patterns result in extended periods of consolidation and sideways movement. Recognizing combinations helps traders anticipate prolonged corrections and adjust their strategies. Complex corrections involve combinations of flats, zigzags, and triangles. These patterns are labeled as double or triple threes and are rare but important for identifying prolonged sideways action. Complex corrections signal indecision in the market and often precede strong moves once resolved. Triangles are corrective patterns that subdivide into 5 waves. A, B, C, D, and E types include barrier, contracting, and expanding triangles. Each type has specific rules for wave movement and termination. Triangles signal consolidation and often precede sharp breakouts. Wave termination points are critical for identifying trend reversals. Channel lines, Fibonacci retracements, and pattern guidelines help estimate where waves will end. Accurate identification of termination points allows traders to set precise entry and exit levels and manage risk effectively. Confirmation of wave patterns is achieved through divergence, MACD signals, and pattern guidelines. Positive and negative divergences, MACD crossovers, and adherence to structural rules provide confidence in wave counts. Confirming wave patterns helps traders avoid false signals and improve accuracy. Common mistakes in wave analysis include mislabeling waves, ignoring alternation, and overlooking Fibonacci retracements. Traders often suffer from analytical and organizational deficiencies, leading to costly errors. Avoiding these mistakes requires discipline, attention to detail, and continuous learning. By following established rules and guidelines, traders can minimize errors and improve performance. The learning curve in trading can be steep, but understanding wave principles, MACD signals, and pattern guidelines helps flatten it. By studying past mistakes and applying proven techniques, traders can avoid costly errors and accelerate their progress. Continuous education and practice are key to mastering market analysis. Applying the knowledge of Elliott waves, MACD, and corrective patterns enables traders to navigate market chaos with confidence. By recognizing wave structures, interpreting MACD signals, and following pattern guidelines, traders can make informed decisions and improve their results. The market's fractal nature offers endless opportunities for those who understand its principles. In summary, the financial markets may seem chaotic, but beneath the surface lies a beautiful organization governed by Elliott waves, MACD signals, and corrective patterns. By mastering these concepts, traders can clear the fog, avoid common mistakes, and minimize their learning curve. The journey to market mastery requires discipline, continuous learning, and a deep understanding of wave principles. With these tools, you can approach trading with confidence and clarity.